Let's continue with some further discussion on theories about how managers decide how much money to borrow. The next concept is something called the trade-off theory. It balances tax benefits and bankruptcy costs. Uh, Johnson and Johnson provides an example. It maintains a AAA rating by limiting debt to preserve flexibility and minimize bankruptcy risk, even though it could borrow fairly cheaply. So, how this works is as you borrow more, the chance of financial distress and costs increase. It is curvilinear. The tax benefit is steady, it is a straight line. So, this implies that when we combine these two, there is a point where the costs of distress exceed the benefits of taxation. This creates an optimal point to maximize value. It also implies a point then where we can minimize the costs of financing our weighted average cost of debt. And as you can see here, here is our curvilinear cost of distress, our straight line of taxes. When we add those values together, we find that there is somewhere here an optimal point of debt. So we could theoretically find and determine what is the actual optimal amount of debt to have that will maximize value. At the same time, then it also minimizes the weighted average cost of capital. So, how else are decisions made? There's something referred to as the signaling theory. Um, Equity issuance often signals overvaluation. When do investors want to sell their stock? They want to sell it when they do not think it can go any higher. And of course, the opposite is true for buying the stock. So, signaling is all about information. If managers are repurchasing stock, that is, they're buying the stock, the signal is that the stock is undervalued. And of course, you and I know this. So when we see stocks repurchase, that is a signal that it's a good time to buy. So, for a great example here, when Tesla issued $5 billion in new stock in 2020 after a major price run up, some investors interpreted it as a signal that the stock might be overvalued. Meanwhile, Microsoft rarely issues stock. Instead, they use retained earnings and debt selectively, consistent with what we refer to in the upcoming slide as something called the pecking order theory. The pecking order theory says that firms prefer to use internally generated funds first, that is, retained earnings. They want to use the profits because there's no flotation costs or negative signals. If more funds are needed beyond the retained earnings, then companies will issue debt because it has lower flotation costs than equity, and again, no negative signals. If they still need money beyond that, that's when they are going to issue equity. So, how do investment opportunities fit into this? This implies that firms prefer to use what they have first, then go up the cost chain. The issuance is similar to the residual model. The issuance of shares depends on net income and the investment opportunities to the company. Of course, as investors, we have an understanding of these things. And of course, we will make our choices, our analysis, based on what we see and how we perceive the actions of management. We talked about agency cost in some previous videos, but one agency problem associated with debt is that managers can use corporate funds for non-value maximizing purposes. Managers can use the free cash flow of the company to do things that are not in the best interest of owners. Now, bonds increase financial leverage, and by that, what we're saying is it decreases free cash flow. So, if we can decrease the free cash flow of the company, then there's less money for management to play with. So, this forces discipline on managers to avoid perquisites and non-value added acquisitions. So there are private equity firms like KKR often use high leverage to discipline management. This ensures that managers are going to focus on cash flow. However, high debt has its issues as well. It also risks something called underinvestment. That's what's next slide. So this second agency issue that can be created is this thing called underinvestment. Debt increases the risk of financial distress, and this could scare management. So management may avoid risky projects even if they have positive net present values. Again, their fear of increasing the amount of debt that gets them dangerously close to potential financial distress is an issue. What about market timing? Managers tend to try to time the market. What this means is they issue stocks when prices are higher and they issue debt when rates are lower. In 2020 to 2021, there were tech firms like Snowflake issued equity after their stock prices surged. At the same time, Coca-Cola issued 10 and 30-year bonds at record low interest rates, taking advantage of those cheap debt markets. The challenge with timing the market is something referred to as the efficient market hypothesis. This hypothesis essentially says that in general, managers are rarely correct in trying to time the market. They can't get it right. Also, neither can investors. So this whole idea of trying to choose the right time to move, because of this efficient market hypothesis and information, how we gather it, how we filter it, how we analyze it, because of the efficiency of that, it's very difficult to choose these right times, if you will. So what is the overall empirical evidence? Tax benefits are very important. So the optimal capital structure of $1 of debt adds about 10 to 20 cents to value. On average, firms faced with 25 to 30% debt, they add roughly 3 to 6% to total value. Now, these statistics here, right, come from time periods before the Tax Cut Act of 2017. So they could very likely overstate the benefits of debt. In addition, bankruptcy costs are extremely expensive. It can cost 10 to 20% of firm value for bankruptcy. Firms have targets. They have a target range that they look for, but they can't make quick corrections when the ratios change, right? So the average speed of adjustment from current capital structure is about 30% a year. Now, if you have a very high cash flow, this might be as high as 50% per year. But the statistics tell us that if you want to change your capital structure, The average time to do that could take 3 to 5 years to make the total change. We talked about this curvilinear structure to the cost of financing, which essentially says on the left-hand side of value, where we're increasing debt to a point of maximum value, there is a slope. That slope is lower than the slope is on the negative side when debt is increasing with financial distress. So if we're above the target, our target capital structure, those distress costs are huge and they rise very rapidly. So some companies will deliberately increase debt to above the target to take advantage of maybe some unexpected investment opportunities. But being to the left of that optimal point has less impact on value. So I think in the end, we're saying what? Taxes are important. Investment opportunities are important. Regardless of the theories, some firms, again, tend to underutilize debt. They attempt to maintain some excess borrowing capacity. Again, especially those companies that are in growth or have growth opportunities, they tend to maintain cash balances and the ability to borrow so they can take advantage of those opportunities. Look forward to seeing you in the next video.